I don't know how far from this you might be, but we are super close to this. We're seeing it firsthand. The banks are not lending. What's going on, everybody? Chris Naugle here with Money School Podcast. And today we're going to talk about the banks, but not just talk about the banks. We're going to talk about why the banks are freezing up. I don't know how far from this you might be, but we are super close to this. We're seeing it firsthand. The banks are not lending. Today, in this episode, what I'm going to do is I'm going to uncover the reasons why banks are freezing up, the reasons why banks aren't closing on deals, are pushing deals, and some of the reasons why we need to be concerned moving into the next year, which is 2025. So let's just get into it a little bit. We all can go back in history and we can see that this wouldn't be the first time this has happened. Matter of fact, this has happened lots of other times in history where banks have literally shut down lending. I've seen banks freeze loans. I've seen banks walk away from loans. I've seen banks freeze and limit the amount we can use from our lines of credit. And I saw the majority of this happen back during the Great Recession. Now, most of you remember the Recession. It was a very difficult recession. It was one that almost took the entire financial system down with it. But what happened during that period of time? Well, let me tell you a little bit about that. During that period of time, there was a lot of turmoil in real estate. Banks were really loose in lending on real estate. And there was a whole bunch of stuff being done with CMOs, GMOs, and, well, we're not going to get into that. But nonetheless, it put banks in a delicate position. They didn't have the reserves. They didn't have the stress tests that they do today. And because of that, when one went, it was just like an entire domino effect. But during that period of time, many of you remember, if you were closing on a real estate deal, maybe an investment real estate deal, the banks froze up. The banks said, nope. The banks walked away from deals, kicked closings way down the line. I remember lines of credit being stopped. I remember banks literally putting the kibosh on someone's home equity line of credit. In other words, like, you got this home equity line of credit, you think you've got X amount of money to use, but then the banks send you a letter saying, hey, because of the appraised values in your area, we are reducing your line of credit. And that actually happened. I remember that vividly during that period of time. And you know what else had happened? During the pandemic. I remember Wells Fargo stopped issuing home equity lines of credit during that period of time. Look it up. We covered that in videos. But now let's fast forward to where we're at right now, 2024, an election year, but an election year where we're starting to see the economy slow down. So what are some of the reasons why deals for a lot of the real estate investors that we work with are not closing? I have heard this far and wide. I've heard this from different funds. I've heard this from individual real estate investors. We literally are in the front line on this one because of privatemoneyclub.com. We hear it. We hear it from the lenders. We hear it from the borrowers, and I'm seeing it firsthand with money I have lent out. Now, I'm not worried about it because these deals will close, but what banks are doing is they are kicking the can. The proverbial can, they're kicking it, and they're not closing deals. They're pausing deals. They're being very conservative in how much they're putting out there, but they're also being very conservative on what they're lending on. They are now going from a risk, a point where they had an appetite for risk to a risk averse approach. So what are some of the reasons? Well, you'd have to go back and you'd have to really understand economics 101 for this one. And you'd also have to understand just how banks and the Fed work. You see, during the pandemic, the Fed printed a whole bunch of money, well over $5 trillion, and they expanded their balance sheet. And what that means is they put a lot of money into the central banking system. In other words, your banks had money to lend, and it was cheap money. Because if you also remember, during that period of time, to stimulate activity, to stimulate business, the Fed dropped interest rates down to close to zero. So they printed a whole bunch of money, and they dropped rates to close to zero. These are things the Fed has in its control. These are the levers that they move. This is the toolkit they have to use, and it's called monetary policy. So there's quantitative tightening and there's quantitative easing. Now, here's some things you must understand. We are in a period of time now where all that money they printed and all that cheap money has created a little bit of a problem because inflation got a hold of us all. Inflation ran pretty crazy, got up over 9%. And when inflation went over 9%, one of the things we must realize is the Fed had to step back in and they had to tighten. So they did the easing during the pandemic. They did the easing during the Great Recession. They did the easing during the dot-com crash, but then they had to tighten every single time. And the tightening came years after the recession, years after the pandemic. Hence, X marks the spot, which is exactly where we're at today. And where we're at today marks a very important period for many of our colleagues, many of our real estate investors, because if you're not careful at what you're doing right now, you're going to get pinched out. In other words, back in the day, we did a lot of BRRRRs, which is where you bought a property, private money, hard money, renovated it, rented it out, and then took it to the bank and refinanced it. Those days right now are getting tough. Those days actually might be gone right now because the banks are really pulling back the risk. They don't want to lend on those kind of deals, maybe a little bit right now, but it's going to get worse before it gets better. But not just that. Let's just say you've got yourself a flip or you got yourself a development deal and you're selling properties and you're like, hey, I rely on these properties closing so that I get my money back. So the bank delivers some of the cash that we put out there. I was looking for a wad of cash to give you an example, but those deals are not closing fast. Even in areas like Florida and other areas, which are title states where deals used to close super quick, they're not. The banks are kicking the can. I know one investor, he's a big developer, and his deal has been kicked now 4 or 5 times. The bank sets the closing date. So just assume this. You got a deal. You got a property you sold. And the bank says, okay, we're going to close on this date. That date comes. You, the seller, goes to your attorney or your title company, gets all the prep, gets the title ready, gets all the numbers ready, sends them over to the bank. And then the bank says, oh, hey, we got to push that closing to next week. At first, or the first 2 times this happened, it's no big deal. But usually that investor has, or that seller has investors that they borrowed money from that are getting checks. And if the bank kicks the can enough times, month after month, those investors, well, they might not get paid because the seller is relying on that property being sold to pay the investors. And the investors have a specific amount of time that they lent the money out on the note. And well, if we're over that time, but yet we're okay because we've got the deal closing and the bank said we're closing this day, but then the bank kicks it a week, 2 weeks, 3 weeks, 4 weeks, 5 weeks, 6 weeks, those investors start getting a bit worried. They start putting pressure on the seller. They start saying, hey, we need our money back. And then in that contract, they have some provisions where they can start foreclosing. They can start putting pressure on. They can start charging late fees. You see, it's a domino effect. One thing leads to another, leads to another, leads to another. The seller of the property had no problems because the property is being sold, but now they're getting behind in interest charges. And on those interest charges, they're getting charged late charges. And then they've got investors really putting pressure on. Do you know where this is going? And it's no fault of the seller. The bank has no penalties, no ramifications for closing late. They don't care. And they'll give you excuses like, oh, well, we don't have enough processors for the amount of volume of loans we have, or this excuse, or that excuse, or this is the reason why. The seller and the investors don't give a shit why the bank isn't closing. They just want their money. Your real estate business lives and dies by the network and the connections that you make. I mean, after all, your network, well, it's your net worth. That's what you always heard, right? If that's an area where you desire improvement, well, Private Money Club is for you. PMC saves you precious time and money by bringing the real estate world, well, right to you. right in the palm of your hand. So get in on the action like so many others have by going to privatemoneyclub.com and sign up. So I've got a list of 5 reasons why banks freeze up. So reason number 1, and it's I could put them up on the screen, but let me just talk through them because I wrote them all down, is regulators. Reason number 1 is regulators. Now, this is more prevalent in small and community-based banks because they are, right now, have a lot of risk on the books. You see, community banks and small banks did a lot of lending on real estate and commercial real estate, which is a very critical period of time. I'm going to cover that in a second. But number 1 is regulators. Regulators are tightening down on these small and commercial banks, which is one of the reasons why these small and commercial banks are having a hard time getting funds or closing on these deals. They've had to pull the reins back because when Silicon Valley Bank, Signature Bank, Republic Bank all went belly up, the regulators are like, whoa, hey, we got to bail these banks out. We don't want to have this problem. So all the rest of you, we're tightening down. We're tightening down on you, and we're tightening down on the money you have to lend, and we're going to be more stringent on who you lend to. So that's number 1. Reason number 2, banks are just holding more money in reserves. You see, banks know that there's this commercial real estate cliff coming, if we're not already there. Banks know that there's something on the horizon, maybe a recession, but they know that consumers are strained, so therefore they're holding more money in reserves in anticipation of consumer delinquencies and defaults. So, the third reason is banks are just uncertain about the future. Think about it. Banks hold they got all the little levers, and they hold literally the future for some real estate investors and many businesses that need capital. I mean, farmers and small businesses, the backbone of this country, all rely on banks for lines of credit and funding for new buildings, new equipment, all sorts of things to keep their operations going. And sometimes just capital and cash flow to keep their business going during hard times. But the banks are looking at it saying, hey, we're seeing a lot more delinquencies. And oh, by the way, I'll cover it in a second, delinquencies are way up, especially on credit cards and commercial real estate. So we won't get into that, and car loans and a bunch of others. But banks are seeing this and they're saying, hey, we want to be a little bit more conservative because we're uncertain about a recession. We're uncertain about the future. So we just want to hold more reserves, which means there's less money to be lent out. Let's keep going. 4th, regional and small banks. We already talked about this. Now, regional and small banks typically lend to small and medium-sized businesses on a local basis, right? Pretty easy to understand that. And they were lending significant amounts of money on commercial real estate. How do I know this? Well, during that period of time from 14 straight up to 18, I was borrowing a ton of money from community banks to fund my commercial real estate. And when you think commercial real estate, a lot of you think these giant buildings, these giant complexes or office complexes or, rentals. No. Commercial real estate is just commercial real estate where the banks are lending to companies. And that could be on a single family, a double, a quad, a 6-unit, an 8-unit, and an 800-unit. They lent a lot of money on these things. And because of that, banks know that most of those commercial loans were on an arm. Okay, or they had a term. So there's a lock-in period of time. So let me just explain that. So most of you understand a 30-year mortgage, right? You get a 30-year, your payments are level for 30 years. And if you understand that, that's all you need to know. A commercial loan typically is issued differently. They are issued for a term of time, like let's call it 20 years. So they usually don't go 30, although they used to, but usually it was 20 or 25 years. But during that 25 years, you have a rate lock period called an ARM, okay, where for 5 years, let's just use 5 years or 7 years, the interest rate was set at that rate. Now, think back to the pandemic when all this was going on. Think back to any period of time in the last decade, rates were low, right? So those lock-in periods might have been 4, 4.5, 5%. That's what mine were. But right now, all of those loans are maturing. They're coming to the end of that rate lock, which means now you need to refi, you need to reset the rate. And guess what happens to the rate? It has gone way up, double for some situations, double for some investors in some businesses, which means an investor and a business owner gets used to a specific payment for 5 to 7 years. Then all of a sudden the bank throws them that letter that says, hey, your bank's mature, or your bank loan is maturing, or your mortgage is maturing. We need to meet about redoing this or refinancing this or resetting the rate on this. I mean, it goes by different terms. And here's the bad news. You're used to 4, your new rate's going to be 8, which means your new payment more likely doubles. And now that the economy is slowing down and economic conditions are shifting and people are struggling, do people have the money to pay double on that loan that they were used to paying a specific amount for? No. So what's happening? They're struggling. And banks know this. Sorry I went long on that, but that's regional and small banks and some commercial banks, but let's mostly focus on small and regionals. Right there, they are getting concerned about that. And because they're the unforeseeable future, what they're doing is they're looking at holding more money and they're looking at lending less, which includes not refinancing some of these loans that are maturing. Fifth, rates are not certain to remain stable. As we know, rates have spiked up from 0 to 5.25 to 5.5, which is the Fed rates. And now we're going to hopefully start seeing rates come back down, which Jerome Powell's kind of opened the door, proverbial door, for a September rate cut. Is it going to be 1/4 point, 0.5%? I don't know, but it's uncertain. So banks know that this is uncertain. Now, here's the thing. The chair of the Federal Reserve recently signaled that the rate increases are coming to an end. So that's a good sign, right? Because now we know they're going to come back down. But because of that, banks also know that means things could be slowing down. Because usually the Fed drops rates when things are slowing down to stimulate growth. A lot of people think, oh, the Fed is just getting inflation down, so they're going to start bringing rates down. That's a small piece of the puzzle. That's a small piece of it. But what it really means is the rates and the uncertainty of rates is taking money off the table for you, me, and all small businesses. Banks just aren't lending it. And the last reason, this is a really good one. It's all tied back to interest rates. Banks' cost of capital. So banks don't just take banks have a cost of capital. Think of it. You give the bank money for your deposit. The bank pays you interest and the bank lends that money out. That's the simplest thing we understand. But when the bank actually lends money, a lot of times they're borrowing that on an overnight rate because rates have been higher. Their cost of that capital has gone up. Actually, their cost of your capital has also gone up because they're paying you a higher interest rate on that. Because the cost of capital goes up, that means their cost of operations goes up. And because the cost to operate and the cost of capital is higher, that is less money to lend. And the last little bonus, which is not in those 6 reasons, I think is a really worthwhile one, and that is the Fed. The Fed controls monetary policy. And the Fed has been tightening their balance sheet. I've covered this a lot, but what that means is as bonds that the Fed holds on the balance sheet, which were about $9 trillion, they are bringing that down to, I believe, around 4 trillion, 5 trillion, somewhere around that. They have been maturing bonds off their balance sheet, which is literally just the effect of that. Think of it this way, would be as those bonds mature off and they don't buy more, take more on, that's literally them just hooking a vacuum cleaner up to the banking system and just sucking money back out. It's money that's not there for you and me. It's money that's not there for the small and regional banks. It's money that's not there for the commercial banks to lend. This is the reason banks are freezing up. Fear, interest rates, Fed, regulators, and overall uncertainty of what's coming. All I'm telling you, folks, is we're seeing it. It's not good. It's going to have effects on your business. I don't care what business you're in. If you borrow money from a bank, if you use a bank, you are going to feel the pinch on this. And that same pinch is going to go straight down. Okay. It's just going to have just almost like a domino effect. It's going to affect hard money lenders, they're going to start freezing up. It's going to affect institutions. You're going to start seeing everything be affected. And when we lose the stock market, which is literally on borrowed time right now, the yield curve uninverted for a short period, listen, game over, folks. We're headed to a recession, but it probably won't come till after the election, because election years, well, they're just goofy. I covered that in a YouTube video. By the way, folks, if you're not subscribed to my YouTube channel, go to @the_Chris_Naugle and subscribe to it and click that little bell so you're notified every time I put new videos out. I will be covering this every single month. You will be front row to this information and you will know how to react. But if you're relying your business on bank financing or selling something that relies on bank financing, things are about to get rough. So prepare. Hold more reserves like the banks are. Get your balance sheet thinned out. Get rid of debt while you still can. Get your company lean and get a contingency plan. Go through your cash flow. Go through your profit and loss. Go through your balance sheet. Where can you start to cut or identify cuts when it's needed? This is just normal business. We all must get ready. We must ease and we must tighten. We ease when times are good. We tighten down when times are rough. We're going into rough times, hard times. It's time to tighten down the bat hatches. Get your business ready. Get your family finances ready. Thanks for joining me for this episode. We'll be covering more and more about this on my YouTube channel. We'll see you on the next one.